I've been investing for over 12 years now. I've seen some frothy all-time highs and some scary lows. Eventually, I managed to get my money to a place where it gives me enough interest that I'd never have to work again. But when I first started out as a beginner in 2012, I had no idea what I was doing. Everyone was saying, invest, invest, but no one actually told you what to invest in or even how to invest it. And so in today's video, I wanna go over with you how I would invest as a beginner in 2026. In this video is gonna be broken down into 5 parts. The first part will discuss why we should invest. The second part, what to invest in. The third part, when and how much should be invested. The fourth part, I'll actually walk through step by step of buying your first stock. And in the fifth part, we're gonna address common questions. And as a disclaimer, none of the following is financial advice. It's simply my lived experience to be used for educational and entertainment purposes only. All right, let's dive in. Part 1. Why do we even bother with investing? Well, to answer it simply, it solves 2 problems. The first problem is an inflation problem. You ever notice how much cheaper things were when we were kids? For example, a Big Mac in 2005 cost $2.58. In 2025, that same Big Mac costs $5.69. A can of Coca-Cola in the 1990s cost around 50 cents. In 2025, it costs $1.50. In these simple differences in price is inflation at work. And it's not a weird bug of the system. In fact, it's by design. The US Central Bank, headed by Jay Powell, actually sets an inflation target of 2 to 3% a year, meaning they want to see prices increase by at least 2 to 3%. So if you have money and it's not growing by at least that amount, then you are losing purchasing power. And the reason we want to invest is not to just keep pace with inflation, but we actually want to beat it. The second reason we invest is to solve the wealth problem. Listen, everybody wants to be rich. And the easiest and surest way to get there is to consistently invest your money. And more importantly, doing so over a long time period so that your money starts working for you to make more money. As an example, let's say you saved $1,000 a month every single month for 40 years. At the end of that, you would have $480,000. Not bad. However, this is an example of you working for your money and nothing else. Instead, if you had that same $1,000 a month invested over 40 years at an 8% return, you'd have a little over $3.1 million. This is an example of your money working for you. And how you seemingly magically end up with $3.1 million is by activating a power-up known as compounding, which Albert Einstein famously determined as the 8th magic wonder of the world. And to illustrate the magic of compounding, let's take that $1,000 that we're investing, 8% a year, over 7 years, you reach your first $100,000. And this is the crucial milestone where really compounding starts to snowball. To go from your first $100,000 to your second would only take you 4 years. To go from $200,000 to $300,000 would only take you 3 years. And to get from $900,000 to $1 million, that $100,000 growth would take you just 1 year. Now that we understand why investing is important, what do we actually invest in? I mean, 8% a year sounds great, but where do we get that? Considering the fact that checking accounts are only giving you 0.01% of interest every year. To do so, we want to invest in stocks and real estate. A stock is very simply purchasing a share in a company. And if that company does well, you get rewarded. However, if the company does poorly, you'll get punished. As an example, let's look at Apple stock, currently trading for $260 a share. If after you purchased it, Apple came out with some amazing news, everyone wants their iPhone, demand is through the roof, well, the stock price likely would go up. However, let's say news came out that the new MacBook is a flop. Nobody wants the iPhone 27. Well, then the stock price would go down. And admittedly, when I first started investing in stocks, I made the most common rookie mistake. I just looked at what did well in the past year, because surely if it did well before, it's gonna keep doing well again, right? Wrong. Let's take an example of BlackBerry. In 2008, they controlled over 50% of the smartphone market. They were also trading at around $147 a share. Fast forward to 2026, BlackBerry, smartphone? Who? That's a crash of over 95%. So instead, what I do now, and the most time-tested approach, is to avoid picking single stocks and putting all of my eggs in one basket. Instead, I invest in index funds. And these are simply what I would think of as a pre-packaged basket of stocks that tries to track a specific part of our financial markets. And some of the most popular index funds are S&P 500 index funds, which seek to track the S&P 500, which is comprised of the 500 largest companies in the US. So in broad terms, if the stock market does well, you do well, and vice versa. Though I bet you're wondering, why would anyone pick an index fund versus just individual stocks? Imagine we have John and Dave in a fruit orchard. They're both very hungry. They've both been given a basket to fill with fruit. John is impatient, so he decides that he's gonna pick as many apples as he can because they're his favorite and the closest tree. Whereas Dave decides that he's gonna shop around and pick a little bit of fruit from each tree. At the end, they both have 10 pounds of fruit. But at the end, it turns out that the apples were not ripe. In addition, they were suffering from some disease, while the other fruits in the orchard were perfectly ripe and they did not suffer the same disease. Well, Dave is perfectly happy to just leave his apples alone and eat the rest of his fruit. John, on the other hand, starves. In this example, we can think of Dave's fruit basket as an index fund. It helps to spread the risk, whereas John's single basket of all apples is the same as a single stock, where it concentrates risk. Now back to that 8%. The S&P 500 historically since inception has averaged 8% a year, and so that's where we get our projections. Keep in mind though, this is an average, meaning some years it can overperform. In other years, it can significantly underperform. This 8% that we use is just an average projection. However, you're not gonna sit there and get 8% every single year for the next 20, 30, 40, 50 years. If you wanted the safest and most secure way to do that, then you wouldn't be investing. You just go pick up a high yield savings account that right now gives anywhere between 3 to 4%. Though if you go back a couple years, they were giving less than 1%. However, with a high yield savings account, you're gonna guarantee to get that interest. It just isn't gonna be as high as what you would get investing it. And as for what specific stocks we're investing in, if you're interested in S&P 500 index funds, you can look for ticker symbols like VOO, IVV, SWPPX. Even though all these ticker symbols are from different companies, it doesn't really matter which one you pick because they all seek to do the same thing, which is track the S&P 500. In addition to S&P 500 index funds, there are index funds that will track literally any index, whether they be in Europe, whether they be in Asia. Now, me personally, I use a Boglehead 3-fund approach where I have a split of US index funds, international index funds, and bond index funds. And specifically, right now my mix is 65% US, about 33% international, and just 2% in bonds. And my strategy for the rest of the year is to actively roll out of US to have more international exposure. Part of that is largely I've had a home country bias where in the past I've had like 98% US exposure, which is way too much concentration. And as for bonds, I keep it very low because I'm relatively young and I'm relatively willing to take risk. And the specific ticker symbols I have for US are VTI, for international is VEA, and a mix of VXUS, and for bonds are BND. For VTI, last year we had a return of 17.1%. For VEA, we had a return of 35.1%. And for VXUS, 32.25%. And for BND, 7.08%. However, if you're just starting out, any US index fund that's tracking either the S&P 500 or the entire US stock market is a great place to start. The other type of investment I want you to look at is real estate. Even though a lot of people are gonna think this is not for beginners, I managed to figure it out as a beginner with zero connections, without knowing anything, literally by just listening to a bunch of podcasts, going to a meetup, talking to some people, and just figuring it out along the way. And I still believe in my heart of hearts, real estate is still the best way to quickly build wealth with anyone who comes from honestly next to no money because of the fact that you can leverage in. And so with real estate, there's two ways you can invest. One is the traditional buy and hold rental real estate. The other is purchasing REITs, which are real estate investment trusts. With the buy and hold real estate, I managed to leverage in and buy my very first house hack where I buy a 2-family, I live in 1 unit, rent out the top, 3.5% down, the bank gave me the rest of the money. Could you imagine if I tried to buy $100,000 of stock and I went to the bank and say, hey, I have $3,500. Will you give me the rest of the money so I can go buy $100,000 of stock? Not gonna happen. With real estate, that very well does happen. And as for returns in the Boston area, 7 to 10% annualized, though for that very first property we bought, within 18 months, we had it reappraised and it appreciated $150,000. And our initial cash outlay was less than $30,000. However, I understand not everyone wants to roll their sleeves up, So REITs are also a good way to get exposure into real estate. And all a REIT is you are investing money in a company that then invests in real estate. As an example, we have WellCare Inc. with ticker symbol WELL. In this, primarily they're investing in healthcare and senior care facilities. Last year they had a return of 36.04%. Though personally, I think that's a little bit concentrated risk because, well, you have to kind of understand that particular segment of real estate. And so to get broader exposure into real estate, you can look at a ticker symbol like VNQ, which is actually a REIT mutual fund. For the purpose of this video, we're gonna move on. However, if you're interested in real estate investing, comment down below. I can always make a separate video. I'm still a huge proponent of investing in real estate. I really do think that is the ultimate wealth accelerator. Section 3. When should you start investing and how much do you invest? As for the when, ASAP. Listen, as a beginner, your biggest disadvantage is you probably don't have a lot of money and you don't know what you're doing. Your biggest advantage though is you have time. Let's say you had a goal to have $1 million by the time you retire at age 63. Assuming an average return of 8% a year, if you start investing at age 61, you would have to invest $17,746 a month. If you start at age 51, you'd have to invest $3,246 a month. At 41, it would be $1,153 a month. At 31, just $474 a month. And if you really came out the gates swinging at age 21, you would just have to invest $205 a month. But don't take this as ageist. It's never too late to start. Even if you are in your 50s and 60s, some amount of compounding is better than zero. And if you are early on, if you haven't started investing yet, hopefully this gives you some motivation to get going now because you're able to invest way less each month to get to that same $1 million. As for how much money you should be investing, I've got a couple rule of thumb, though generally I would say as much as you can spare. The first is if your company gives you a 401k or 403b match, take that full match. It's literally free money. The second thing, you can use one of the more commonly accepted budgeting templates / frameworks out there, the 50-30-20. So 50% goes to needs, 30% goes to wants, and 20% goes to savings and investments. And as for which accounts you should be investing in, the first is making sure that you have a tax advantaged account, such as a 401k, 403b, a IRA. These are gonna help your tax situation get those open. Once those are sorted, settled, and funded, then I would be putting money into a brokerage account. So this can come from Schwab, Fidelity, Vanguard. And I don't care if you're just starting at the age of 40 with $1, or you're starting at the age of 21 with $200. The key here is the psychology of investing, that you're training that mental muscle to have money each month that you take out of your account, put it into investment so that it can start working for you. Because a couple things. One, it helps you delay gratification because, hey, listen, for me, it's like if I don't see it in the bank account, then, it's good, it's gone. However, by delaying that gratification, you get a much richer reward years down the track versus today you go and spend it on who knows what. And the second thing is you're making sure that your money is working for you. That compound interest has the time to start actually compounding and growing your wealth. Section 4. Now let's walk through an example of how to buy a stock. Me personally, Charles Schwab is my main brokerage, though you could use any Fidelity, Vanguard. I wouldn't recommend going towards like the Robinhoods and Weebles of the world because of the fact that they're very flashy and they make investing feel like a game. And so by gamifying it, you're more likely to trade. If you're more likely to trade, you're more likely to lose money. That's just the psychology of how those platforms work. I pick a very boring, almost dated looking UI because investing is boring. Like I shouldn't be doing all that much. I shouldn't be getting confetti when I purchase a stock. Anyway, that's just a little bit of an aside. So I open Schwab and let's go ahead and search for the ticker symbol VEA. As soon as I pull up VEA's page, you're gonna be inundated with information. The 52-week high, the bid-ask spread, the composition, the growth. I'm gonna tell you right now, none of that matters. Just go ahead and click that little buy button. So with Schwab, I can either buy a single share or I can click that little calculator button. I can put in, say I had $1,000, and then it will tell me how many shares I can afford. The next one we'll look at is the order type. There's a couple here. Market order basically means whatever price is out on the open market, I'm willing to pay for. A limit order simply says, this is the maximum I'm willing to pay, and if it's over that, I won't buy it. If it's under that, I'll purchase it. And then we also have a stop limit order, where if the price hits a certain threshold, but not below another threshold, that's when you will purchase. And for the purposes of beginners, what I would rather do is set a limit order, which basically sets my price. And if someone is selling at that price I'm willing to buy, I execute. If someone is selling for more than that, I will not execute. So we hit confirm and go to the next page. And I actually got this little pop-up that basically says that the order is executable because what I'm willing to buy at 342.41 is higher than when someone is willing to sell, which is 324.40. Not a big deal in this instance. It's literally 1 cent, so I confirm, and that's it. We've just purchased our first stock. Section 5, some common Q&A. Should I time the market? No. Time in the market beats time in the market. It's very intuitive to think you're just gonna buy low, sell high. Very rarely can people actually execute on that. In fact, if you had just sat out and you did not participate in the market when it had its 20 best performing days, you would have missed out on potential 50% of wealth gain. Is index fund investing 100% safe? No. Investing is inherently risky. And the reason that index funds and stocks pay you more interest than your bank account is because you are taking more risk. And by taking more risk, you are rewarded with the potential of a higher return. What index funds offer is diversification. Instead of having all of your eggs in one basket, you have that fruit basket we talked about. Now, at the end of the day though, with all investing, there is still a potential that you will lose money. Should I day trade? I see all these ads for it. No. 97% of day traders who are still in the market after over 300 days have lost their money. In fact, only 1.1% managed to make a minimum wage when you factor in the amount of time they spent and the amount of money they actually make. Listen folks, the people who are making money day trading are the ones selling you the courses. Unless you have a PhD in applied mathematics or physics or computer science, don't try day trading. My buddy made like 80% investing in Nvidia. 8% sounds horrible. Well, 2 things. 1, I am jealous of your buddy. However, they got lucky, pure and simple. Nvidia for the longest time were just making GPUs for gaming machines. They caught the AI craze, right time, right place, I'll give them that, but same as your buddy. Right time, right place, very lucky. The second thing, chasing home runs is the surest way that you go broke. Folks, at the end of the day, the stock market historically goes up and to the right. Yes, we're not gonna get 50, 80, 100% returns in a year, but I will take that 8% compounding any given day simply for the fact that it's less likely to go into negative 20, 30, 40, 50, 100% if I make the wrong bet on a singular stock. Final question, should I work with a financial advisor? I have no idea what I'm doing. To be perfectly honestly, folks, no one should work with a financial advisor if you think the financial advisor is gonna help you make more money. They're not gonna make any more money than an index fund. And you yourself can purchase index funds. The value that a financial advisor provides is to keep you calm when shit hits the fan. When the market's down 25% and you wanna hit the sell button, they can be a person that says, hey, calm down. Remember, this is not part of the plan. We're gonna ride this through. That's where the value comes in. So if you're just generally a twitchy person, you kind of get nervous, like you see loss and you're like, oh God, I don't know what to do, find a financial advisor. For everyone else, no. And if you are gonna find a financial advisor, folks, make sure that they are not an AUM advisor that charges you a percentage of your overall portfolio as a fee. Make sure they are a fixed fee advisor, meaning they charge you a fixed amount no matter how big your portfolio is. An advisor that charges you a percentage fee is absolutely outdated. Do not go for them. All right, cool. Anyway, this has been the video. Hopefully this was helpful as a beginner guide to investing in 2026. If you have comments, questions, drop it down below. If there's anything you missed, happy to help out. And again, if you guys are interested in talking more about real estate, happy to make a follow-up video. As always, I'll catch you on the next one. Peace.